there's just so much power in starting something, just throwing all caution to the wind and just starting, whatever it is. It could be investing, it could be starting a YouTube channel, whatever it is that you want to do, man, just start and just don't stop. Okay. There's going to be so much that you don't know. And there's going to be so much you have to figure out, but you could really go a long way if you just start and do not stop, and you figure out the rest as you go.
Investors, welcome back to Masters of the Market, where, of course, every single week we are bringing on a master of the market. And joining me again for his second time on the show here is Ryne Williams, a fellow YouTuber, an outstanding dividend investor, and, of course, a good friend that I've met along the journey of dividend investing. Ryne, I want to say welcome back to Masters of the Market. Happy to have you back on. Grateful as always. And
thank you, man. I'm so stoked to be here. Sorry, I didn't mean to cut you off.
No, it's all good, man. I wanted to bring you back on. Actually, I'm just going to be open and honest, transparent with everybody out there. I reached out to Ryne the other day and wanted him to come back onto Masters of the Market because I saw an outstanding new series that Ryne has on his channel, and it's his Walk to 100, and it sparked a lot of questions on my end, to which I'm going to throw all those questions out to you in this episode here of Masters of the Market. But I first want to throw this question out to you, Ryne. What exactly is, for those who haven't seen it, what is the Walk to 100? What was the idea behind it? And can you share a little bit about this walk that you're on?
Yeah. Well, bear with me because I might be long-winded with this, but Walk to 100 is a new live stream series I started a few weeks ago at the beginning of November, and it's going on Monday through Friday, 7 a.m. Pacific time, 10 a.m. Eastern time. Basically 30 minutes after the stock market opens. I'm live streaming, and it usually lasts between 20 and 30 minutes or so. But the idea and the name came from a couple different places. So about a month or so ago, I got this. I don't know if you can see it down there, but see that little orange thing in the background under my coffee table there? That is a like a walking, I guess you call it a walking pad, or it's like a mini treadmill, but it's this super portable treadmill that I got on Amazon. And I bought it because I was thinking, I just, sometimes I'm at home and I'm watching TV, or I'm at my standing desk here, and it'd be nice to get some steps in, just burn some extra calories. If I can, just kind of kill two birds with one stone. So I got this thing, and since I got it, like every morning, I've been walking. I've been just getting my steps in right here at my computer, and kind of my morning routine since getting it has been to wake up, get my coffee going. I'll come here, check on the market, check on my portfolio, maybe watch some YouTube stuff, just kind of get tuned into, what's going on in the world of dividend investing. And that's been a really enjoyable morning routine because I can get, caught up on what's going on. I can stay in the loop. I can see how things are going. I can make my buys, see all my dividends for the day, but I can also, burn some calories and get some steps in. It's just overall, it's a really great way to start the day. And so I decided, I might as well film this. I might as well put this out there because some of you guys in the audience might be interested in tuning in and following along with me. And so that's what I decided to do. And I told myself, I'm just going to do it for the entire month of November. I don't know how it's going to go. I don't know if people will be interested in it. I don't know if I'll enjoy doing it because it's kind of a lot, streaming every single day. But I told myself I'm going to give it a month, just give it an honest try and see how it goes. And so that's where I'm at with it. It's November 16th, so we're halfway through the month, and I've got to say it's been a lot of fun so far. Like I said, it's been a really solid routine. When it's all said and done, every single morning I'm burning 100 calories, which brings me to the name in itself, Walk to 100. Why call it Walk to 100 of all things? The reason is twofold. Number one, the rule with this stream is I can't stop streaming. I can't stop walking until I burn at least 100 calories. That's Walk to 100. Number one, we're burning those calories step by step. But in addition to that, as you know, Ari, as many of you guys know out there, building your portfolio and reaching financial freedom is not something that happens overnight. It's just, you don't just make one contribution to your portfolio and then boom, you're ready to retire. It's something that happens only with consistency and with discipline and with, week in, week out, day in, day out, contributing to your portfolio, buying stocks, collecting that cash flow, reinvesting it. So in a nutshell, it's something that happens step by step. And it's not a sprint. Reaching financial freedom is a marathon, as they say. And so you're not running, you're not galloping, you're not sprinting to financial freedom. You're walking. It's a long journey. And me personally, my portfolio is valued at now about $55,000. So I'm not even at $100,000 yet. So in that sense, I'm also walking to 100. And for me, this live stream series is a way to just kind of document in an additional way what's happening in my portfolio and show the, I want to call it grueling, but that's probably not the right word. Show the long and tedious journey that it takes to build wealth with this style of investing, which is not something that everyone wants to go through. It's not something that everyone wants to experience. But hopefully by doing this, by showing the walk to 100, it can inspire others to do the same. But furthermore, I just think there's so many similarities between the physical walking and also the theoretical walking to 100. Both when it comes to investing and when it comes to getting in shape or health and fitness or whatever, which is another big part of my life outside of investing. That's something I'm very interested in and try and talk about a lot. Because I also think obviously it's important to be in good physical health in the same way that it's important to be financially healthy as well, which is kind of what you get from investing over time. But if you have goals in both of these departments, the means to achieve those goals is one and the same. It's all rooted in consistency. It's all rooted in discipline, and it's rooted in incremental progress, incremental steps forward, walking, taking it step by step in both ways. And so I figured that doing this stream was a pretty fitting way to combine those, number one, combine those two things I'm interested in, as well as try and lead by an example as it pertains to being disciplined, being consistent, both in terms of getting the steps in and also, building up the portfolio. So try and lead by example in that regard, but also number three, inspire others to do the same, to start investing or keep investing, even in the face of how long it takes, even when you don't always feel motivated to do so, even when there's other things you'd rather spend your money on. I want to inspire others to stay consistent and stay disciplined, because over time, it really makes a big difference. And like I said, those incremental changes, that incremental progress, taking it step by step, those steps have a way of compounding over time, both in your portfolio and also for your waistline as well. So,
sure.
Like I said, I was going to be pretty long-winded with that, but that's walk to 100 in a nutshell.
Look, I have to say, I mean, I think a lot of us have been watching, your channel. We've been watching your growth on YouTube, the growth within your portfolio, and consistency remains a key factor, I think, when it comes to Ryne Williams. And just to, I don't know if you know this, the last time you were actually on here is about 3 months ago, and your portfolio had just popped above 51,000. I'm sorry, 50,000. Just popped above 50,000. And now you're above 55,000. And so now in this walk to 100, you've started here every day walking right to the 100 calories, but slowly but surely adding to your portfolio and building upon, the dividend stocks within your portfolio. I'd love to know whether it was from the last you were on or even now during this walk to 100, what have been some of the things that you've learned just on this walk alone?
That's a really fantastic question. And I wish I would have known that one ahead of time, because I'm not prepared. So what have I learned? I think I don't know that I've necessarily learned anything new, but it's the couple weeks that I've been doing this, it's really been reinforced just how much symmetry you can find between those two things. And I'm also learning, I guess if I learn anything new, I'm also learning how interested the audience actually is in health and fitness. And I think it makes sense too. I think I think there's something to be said. Like, it feels good to be disciplined, and it feels good to be consistent, and it feels good to see yourself taking steps towards financial freedom and taking steps towards building your portfolio. It's a pretty rewarding thing, knowing you're making a positive difference for your financial future. And I think I'm starting to see people in the audience, people in the live stream, do something physical along with watching me talk about stocks and walking myself, which is great. Like, I'm really glad to see that happening. There's people who will hop on their Peloton and they'll ride as they're watching this. There's people who go out. There's one guy who does a 5-mile walk every single day, and he listens to this as he's doing that. And I guess I'm learning just how interested people are in this other thing as well, and which is great. I really wanted to inspire people to, not only build their portfolio or keep building their portfolios, but also, try and become more physically healthy if they're not already taking steps to do so, literally and figuratively. Because we want to be around as long as we can, especially with this dividend investing thing. As you know, time in the market beats timing the market. And you want to give yourself the most amount of time possible to reap the rewards of all your investing, of all your hard work over the years. Someday when you can reach financial freedom, or when you have enough dividends to cover all your expenses and you're finally there, you know what I mean?
Sure.
On the other side of all this, of having to be patient and all those years of adding to the portfolio, on the other side of that is this thing that you daydream about every single day. And when you finally reach it, you want to be around as long as you can to experience it and bask in that, because it's a really, really great thing. And so I think by doing that now, just by doing whatever you can, even if it's just, walking for 30-45 minutes on your walking pad or your little treadmill in the living room, that makes a big difference over time. So in a nutshell, what have I learned? I'm learning that people are really interested in that as well, which makes sense, because like I said, when you get to the root of how to be successful with both of them, it's one and the same. So it's like, if you're okay being consistent and disciplined in your portfolio, you might be okay being disciplined and walking and burning 100 calories a day or something.
Sure.
But it's been really cool to see some people start to implement some positive habits for their physical health too. I think it's been really cool.
That's incredible. I mean, it really is. It also, for me, it just, again, it hits that consistency bell, right? Like those who are joining you, it sounds like you have a consistent crowd join you on the live stream. And it's cool now to see that they're also now exercising along with you, but they seem to be consistent players across the board. Last week I had Harris from One Penny at a Time on the Masters of the Market series here. And something that rang true for my chat with him, thanks to you, was this notion of like, just start. And, what was interesting is that, after I rewatched our conversation, then I started watching your Walk to 100. I was like, just start, right? Is Harris's big message, and just be consistent is kind of Ryne's, right? Like, just show up, just keep investing, just keep going at it. Is there anything that you have in the past month or so, right, in November at least, realized as an investor that perhaps you needed to adjust or readjust how you're coming at dividend investing or investing based on the actions that you're taking or not taking?
Not necessarily. I think, I think sometimes we feel some pressure to really like stay in the loop and what's going on in the market and in our portfolio. And I knew this before starting the stream, but I guess after a couple weeks of doing it, like, not much changes. Like, it's okay if you don't tune in every morning. It's okay if you don't check your portfolio every day. I think, I don't know how to answer this question, to be honest, because it really is a tough one. As far as like, I guess, habits as an investor, things that could be changed. To be honest, I'm really not doing a good job of answering this question, but I don't know.
You said something interesting, to be honest, though, right? Like, you kind of said to me what it sounds like is like, out of every day that you punched that ticket, right, to take out the little treadmill, to walk to 100 and be in the investing space focused and consistent, you don't necessarily need to be, your head in the market every day like that, for you to have a growing, prosperous portfolio. At least what it sounds like to me. Like, you don't need to be so head in the game, all about investing. You can pump the brakes and have some days where you just take a break, take a breather.
Yeah. Going back to your question, though, I'll be honest. I just don't really know. I don't know that I've been doing it long enough to really feel any sort of change in myself or things that need to change in the portfolio. Yeah. I don't know. I know I did a terrible job answering this question, and I apologize.
There's no right or wrongs there, man. You're only in the hot seat.
It's starting to feel hot, I'll tell you what.
So have you started to like dollar cost averaging, right? You're a big fan of dollar cost averaging. Do you throw money into the market every day? And has the walk, like, has it kind of forced you to throw more money into the market and invest every day? Or are there some days you don't invest?
Yeah, dude, that's a great question. That's a fantastic question. No, I'm a big proponent for dollar cost averaging, but once again, I don't feel like you need to do things every single day. If you don't want to, you certainly can. Like, let's say you've got, $150 that you're going to invest every single week. You can do that in one foul swoop, or you could do $30 a day. And I think over a long period of time, it probably all works out to be more or less the same. So, it's pretty preferential. Now, just for the sake of content, of just creating content and showing something, buying every day and breaking up my weekly contributions into like a daily buy is something that crossed my mind, but there's no real purpose behind it outside of that. Like, so if someone's out there thinking, should I buy every day? Should I buy every week? Should I buy every month? Which is actually a pretty common question that I get. And I'm sure you do as well, Ari. It doesn't matter. Like, what's important is that you're consistent, but really at the end of the day, the frequency is irrelevant. If you want to buy once a month, once a week, once a day, do whatever works for you. I don't know where I was going with that. I think that was pretty much it.
Do you feel you were I mean, I'm fascinated with like how much dedication that's going into the walk to 100, right? And I almost feel like it may be easy to, almost have, especially these days, man, with everything that's going on, but like these little panic attacks or like emotional scares, or maybe on the converse of that, right? It's like, I know actually since I started working now professionally in the financial space, I'm taking in so much financial news every day nonstop that I've almost become numb to the market swings. Have you picked up on that on your journey?
Yeah, certainly. That's a really good point. Like that's a really good point. And I guess if you don't check the market as often, it can be maybe a bit more debilitating if you open up your portfolio for the first time in a week or 2 weeks and see it's down a crazy amount. That might affect you more so than if you were to consistently check it like every single day. I guess I've felt the same, and at least these last couple of weeks that I've been doing this, November, as you know, has been kind of a roller coaster month. I mean, so far this week, it's been a lot of green, but otherwise, like there's been a decent amount of red that we've been experiencing here and there. And so it seems like it's been quite the roller coaster. But to your point, yeah, it does kind of numb you in a way. I didn't numb you to it. I didn't really think about that. But I also think that's a good thing. I think you should be kind of numb to the day-to-day fluctuations because, I mean, as you know, you're not investing for today. What happens today, and also what happens in the last 1 year period, it's kind of irrelevant because you're investing for today for 20, 30, 40 years down the road. So the day-to-day, variance in share price doesn't really mean much. And it's easy to fixate on that, especially if you're someone who hasn't gotten those reps in, and experienced that before, or doesn't have much experience with it. It can be something that affects you in a pretty big way. But yeah, to your point, Ari, it just the longer that you do this, the less that it affects you. And I think that's true with a lot of things. I think when it comes to investing, there's so much that you learn just by spending time in the market. You know what I mean? Like, and that's true with anything. Like the more you do it, the better you get, or the more accustomed to the nuances that come with it that you become. And so, yeah, I think you reach a certain point where you understand that there's going to be good days and there's going to be bad days. And if you have that long-term mindset, if you're looking 20, 30 years into the future, well, then you can look at these down days instead of being something that, kind of puts you in a hole for the day. It can actually be something that excites you, especially for what we do in creating that cash flow, because it can be a buying opportunity. So it's something to actually celebrate, interestingly enough.
Now I know this because I have the privilege and pleasure of, being able to talk to you, not every day, but, time to time here when we're chit-chatting. And, I know this, right? You're a very reflective guy, which, for me, it made sense why you actually started walking to 100. I'm like, this is a very classic Ryne move, right?
Thanks, man.
Also just trailblazing the content, by the way. Like it first started, with the Dividend happy hour, and I saw the thumbnails for the Dividend happy hour. I was like, wow, this is killer, man. I wish I came up with this. And then here we are, take 2, walk to 100. I'm like, what is walk to 100? I got to check this out. But you have this very reflective, right, like mentality. I know you're constantly thinking, as an investor, you're doing a lot of reading as well. And so I want to kind of jump into this question with you, knowing now, like you've come so far, man. From 2020, or me and you first started our channels, right? What's 1 or 2 things that you now know definitively?
Couple really important things. First of all, thank you for the kind words, man. We both have definitely come a long way over these last few years. It's been cool to see, and I can only imagine what these next handful of years are going to look like. It'll be fun to look back on today, a few years into the future, and hopefully see how much more wise we've become in that time. and better at investing as well. Couple of things that I know definitively, and you touched on this first one earlier. There's just so much power in starting something, just throwing all caution to the wind and just starting whatever it is. It could be investing, it could be starting a YouTube channel, whatever it is that you want to do. Man, just start and just don't stop. You're not going to be good at first. You're going to suck. Okay, there's going to be so much that you don't know, and there's going to be so much you have to figure out. But yeah, you could really go a long way if you just start and do not stop, and you figure out the rest as you go. That's certainly been true as it pertains to investing. I started doing this, as I always talk about this. I started doing this with no experience. I had no idea what I was doing. And, in a lot of ways, I still don't, but definitely have come a long way. And fortunately, investing is one of those things. It's an infinite game. It never stops. It's something that you do until you're no longer here. It's a lifelong game that you can play, which is one of the things that I really enjoy about it. And because of that, you're never going to reach a point where you've got it figured out. So with that said, you are constantly in a state of figuring it out. You are a constant student of the game. And so because of that, because it's a never ending journey, I just think that's all the more reason to start, even if you don't know all the answers or know exactly what you're doing, just start. And that kind of brings me to the second point, is that it's okay to make mistakes. You're going to make mistakes. You're going to make some wrong moves. You're going to buy some businesses that don't work out. You're going to do things that a couple years down the road you look back on and probably wish you would have done, or you will, with hindsight, be able to see where you went wrong. And once again, just like with anything else you do, it's something that's going to happen, and you shouldn't let that prevent you from starting at all. So those have been two pretty important things that I've learned. But I want to throw, just kind of tying that all together, and those two go kind of hand in hand. It's almost like one big thing. But to really tie that all together, I feel this way about my portfolio, and I feel this way about my channel as well, is that you just never know. Like, if you do start and you stay consistent, you stay disciplined, you never know what these things can grow into. You just never know what can happen. There's a lot of power in being consistent. There's a lot of progress to be made. And so you just never know what these things can grow into. I feel like I've made some really great strides in both departments these last few years. And man, if you would have told me 5 years ago that my full-time job would be making videos talking about dividend stocks of all things, I would not have believed you at all. It's just life takes you in some funny directions sometimes, but that's part of the fun, I suppose. And yeah, you just never know what these things can grow into. But furthermore, if you would have told me, like, I'm at a point now in my portfolio where I'm bringing in $200 on average every single month without having to lift a finger. And that's not, you're not going to retire off that today. You're not supposed to. It's a long process, like we've talked about, but $200 without having to do anything, that's huge. So just start, don't stop, and just know you're going to make mistakes, but also know that it'll be fine.
Great pieces of advice. What can you speak to some of the mistakes that you've made?
Fortunately, I haven't made too many big mistakes. I've bought companies where I've lost some money. I put out a video yesterday, actually, where I talk about a few stocks I'm going to be selling out of, a couple of which that I probably will sell for a loss. But, one mistake is just, yield chasing is a pretty big one. Unfortunately, I didn't fall victim to that too hard. Like, there's been a couple of stocks in my portfolio where I've done so, but it's never been anything super catastrophic. So that's something. I think borrowing conviction and, investing in something just because you saw someone else talking about it or because someone else that you follow has it in their portfolio, I think that's a big issue. And I think that's something that a lot of us do have to learn the hard way. And that's something that I certainly had to learn the hard way. Because like I said, I came into this not really knowing what I was doing. And instead of going just into ETFs or something, which is probably what I should have done, I went all individual stocks and it ended up working out fine. But because you don't really know what you're doing when you first start, you don't really know what to look for. And so all you really have to go off of is what other people are saying and what other people are doing, for better or for worse. But yeah, that's been a big lesson for me, is to, as quick as I can, knowing that I don't know a lot or anything, start learning, start learning how to read financial statements, start knowing what to look for. You'll probably screw some things up along the way, but that's okay. You'll make progress. But that's been those two things have been just really big learning, the two big lessons that I've learned for sure.
You brought up a really interesting point. Actually, that I mean, it got me too, right? And you use the term borrowing conviction. I love that. But you mentioned this borrowing conviction and kind of finding people and gravitating towards them and then chasing a stock based on their chase, right? My question for you is, while that's not a liable, right, investment strategy, I don't recommend doing that at all. You're a YouTuber talking about dividend stocks, which stocks to buy. I'm a YouTuber talking about dividend stocks and which dividend stocks to buy, right? There's a lot of us out there. What piece of advice could you give all of us of who to kind of stay clear from or navigate away from and who to gravitate towards while you're doing this, I guess, YouTube due diligence?
That's a really hard question to answer. And obviously I don't want to speak disparagingly of anyone else out there creating content. And I certainly don't want to say anything that would suggest that I have it all figured out or know better than other people do, because I don't. I could be wrong and have been wrong before about the things that I do. I would, to someone, if you're a new investor and you are turning to YouTube or other mediums such as similar to this to find stocks and figure out how to invest, take it all in. Just absorb as much as you can. Through osmosis, you will learn, and you will use that information to start making decisions for yourself, I suppose. And there's going to be some good and some bad advice for sure, but I do think it's your responsibility and it's part of the journey to discern what's going to be the good from the bad, and you'll figure that out over time as you absorb more information, listen to more people who have differing opinions. You'll take what resonates with you and leave what doesn't. And so in a nutshell, I would advise everyone just take it all in, see what stands out to you, see what you can take away from everyone, because everyone's got something to offer in some capacity. So yeah, just take it all in. I wouldn't say stay away from any one person or thing or idea, because you also don't want to be too dogmatic in all of this, because this is an infinite game, and it's one where it's a constant learning experience. You are going to be constantly going to be a student of the game. And so, yeah, keep an open mind, especially considering this is such a fluid situation. The market is perpetual. Things are always changing. So keep an open mind, take in as much information as you can. And over time, you'll come into your own and be able to, develop your own thoughts from there, I suppose. But I guess you got to use that as a starting point. And I will say, kind of on that note, as it pertains to watching YouTubers like Ari and myself and everyone else out there creating content, sharing their portfolios, sharing stock ideas, take that with a grain of salt. Don't take any of this stuff at face value. And as they say, entertainment purposes only, for sure. It's a huge cliche. It's not financial advice, all that jazz. It's totally true. Like I said, it is a cliche, but just take it for what it is. It's just someone talking about what they're doing and what they think at that point in time. And that might change down the road, because we're all just, we're all just trying to do the best we can and trying to become the best investors that we can, which is a never ending process. So your thought process and what you think about certain companies and ways to invest will naturally change over time, as it should. And so just understand that when you're taking all this stuff in, and if someone's talking about, as we put out videos like these all the time, the best stocks to buy or 3 deeply discounted stocks to buy in December, don't use that as your entire investment thesis.
Buy now, immediately.
Yeah. And I don't want to say this, but that's just part of the territory that comes with creating content in this space, I suppose. And I'm not trying to defend that necessarily, but at the same time, I think just take it for what it is. It's just, you come to YouTube, you go to Seeking Alpha and read articles, you come here and watch videos, you listen to Ari, you listen to me, you listen to everyone else. It's just ideas. Just take all these different things that you hear and you see as ideas. A YouTube video talking about 3 stocks to buy is not going to be and should not be your entire investment thesis. And you shouldn't borrow someone else's conviction and take these ideas, which is all they are, and run with them. At first, if you're just starting out, you don't have much else to go off of. That's fine. Luckily, hopefully, you won't be dumping your entire life savings into one particular holding, unless it's something like VU, you know what I mean, or VTI or something like that. That's more acceptable. But not dumping all your money into something like Zim just because someone was talking about it. Those things like that you can avoid. But I don't know. It's tough. Like the internet, man. And I'm sorry to be rambling, but the internet, it's such a blessing and a curse. Like we're so fortunate to live in a time where we have access to all this information and all these different ideas. But at the same time, it's easy to just take these different ideas and run with them and use them as your own, when you should really just use them as maybe a starting point to do further research.
Sure. No, it's interesting you shared in the beginning, this is kind of how you were doing some of your research, right? Like finding the people, borrowing the conviction, trialing and erroring. How have you evolved in that capacity? Like, what's your process like now? Because I could tell you, I don't even, I used to do the same thing, by the way. I used to pop onto YouTube, what stocks to buy now, or
Yeah.
go to Google, right? Best stocks to buy now today. And then I'd get a list of what I always call ideas. And then I would go from there. To be honest with you, these days, I don't even do that. I do none of that. So I'm curious to know what your process looks like these days.
Yeah. It's an interesting point, man. When you first get into this stuff and first get real excited about it, it's like all you want to do is watch someone talk about dividend investing. It could whatever. You want to soak it all up. But as you spend more time in this space, and as you kind of evolve and progress as an investor, you don't really need that as much, because you learn what to do. You start to learn what to look for, and you start to figure out how to make your own decisions, I suppose. And so it's interesting. Like I find myself watching less content and less videos these days than I used to when I was first getting into it. I still watch some. I think I still really enjoy it. There's a lot of really good creators in this space, and it's really cool to see other people's portfolios. I'd say that's still like one of my favorite things to do. See how much dividend income someone's bringing in, or see what they're buying, or stuff like that. And dude, I take so much inspiration from watching someone like Gen X Dividend Investor, who's living off of dividends, or PPC Ian. A lot of times, like no matter what's going on with certain stocks or whatever, he's a pretty calming and I think optimistic voice in the space. And I think we need that from time to time. So I still enjoy that. And I'm kind of forgetting what your initial question was. I'm sorry, man.
The process that you now have in place.
Yeah. So just in terms of stock research, you mean, or what?
Yeah, like okay, you no longer, typing in best dividend stocks to buy now. What's it look like for Ryne Williams, a few years deep into the journey?
I think there's so many ways to hear about new stocks. I think I get told about a lot of stocks just from the Discord group, or from people leaving comments mentioning a stock, or even watching videos, which I still, do, not as obsessively as I used to. But so there's a handful of different places to get ideas. And I feel like we're both in a really fortunate position where we have people in the community sharing their ideas with us, and asking us about stocks. And so it exposes you to things that you might not have heard of before. But from there, I would say, and once again, this is something that's going to evolve over time, your stock research process. And I'm working on something too, where I like some sort of like start to finish place to house all that research and just to get it all down on paper so you don't forget it. But I would say one of the first places that I start, if I hear about a stock, let's say you tell me about a stock that I've never heard of before, I'll go over to Seeking Alpha. One of the first things I do is see, what is this company? What do they even do? Do I understand it? And that's been a big thing for me lately. And that's one of the other things, I should have mentioned this earlier, that I've really had to learn the hard way, is staying within what Warren Buffett would call your circle of competence, which essentially is this realm of things that you understand. Because you shouldn't invest in something if it's over your head. You might hear about something that someone tells you is the next hot thing, or something like that. But if it's way over your head and you don't get it, just you're best off staying away from it, because you're not going to know what to do when you own it. And if it goes down, you don't know why it goes down. You don't know if it'll go back up. It's just hard to have confidence in something you don't understand. So that's the first thing, is I make sure that whatever that is within my wheelhouse. And as I'm paying more attention to that, I'm realizing just how underdeveloped my circle is, and how small that diameter is, which is fine. You don't need a billion different ideas. You just need a few good picks, I suppose. And so that's the first thing. If I can understand what's going on here, then I'll move on to just starting to look at the financials. And it's like a very quick scan at first. Are they growing in sales? What's their gross profit margin historically looking like? How is that trending? And then I kind of work my way down the income statement from there. and then go over to the balance sheet and see what's the debt situation looking like. Do they have a lot of debt? Are they negative net on a net basis for debt, which is really exciting. I feel like it's really refreshing to see a company with no debt. And I'm not saying debt's bad. It's got its purpose, but like it's just one thing you don't have to worry about if a company has negative net debt. You know what I mean? And then I'll look if they have some debt, how does that compare to their, free cash flow? Are they able to service that debt? Stuff like that. So I'll just take a quick scan through the financials and see what's going on at a very high level. And then look at the dividend stats. What is this company all about? Are they a high yielder? Are they a high growth stock, high dividend growth stock? Is that CAGR in the double digits or close to being there? Do they have a dividend growth history? Where's the payout ratio? Those sort of things. And if I kind of get through those few introductory things, and a lot of the boxes are checked and everything looks swimmingly, I don't know if that's the right word, but everything looks good, then
Sounds great.
I'll consider it for further evaluation. Yeah. But that's in a very brief nutshell. That's how I'm doing at least my initial stock research. And then at some point I take time to do all of that stuff on an even deeper level. And I've started to do that in what I'm calling my dividend database. It's something I'm going to be rolling out at some point. I'm still fine-tuning it all, fine-tuning the process, but I use that to house all of my stock research. It's like my second brain for investing. So I'll go through and just take down notes on everything that I can think of, like what this company does and how they make money, a lot of the financial metrics, stuff like that. I'll really think about their competitive advantages, if they have any disadvantages, kind of go through the bull and the bear case, and try as best as I can in as of detailed a fashion as I can to get it all down in this database. Number one, so I can refer back to it, but number two, just by taking it here and putting it there, it just helps you develop a better understanding of the way you think, I suppose. If it's just sits there in your cerebellum, if it just sits there up in your head, some of those thoughts can be fleeting. You might forget things, but if you write it down and take time to do that, it can make a big impact, and it can help you organize. Number one, just have those thoughts be more concrete, but also can help you organize it and stay organized. And I don't do that with I've just kind of started to do that, but I have a feeling that's going to be a very helpful thing for me as it pertains to doing stock research. It's going to make it more tedious for sure, but that's okay. It's worth it.
So what's your portfolio at this point look like? Because I know the last, Masters of the Market chat that we were on, together, you were shared, in terms of building a dividend stock portfolio, to have 70 plus, positions in there might not be the best strategy, because you want to make sure that especially when you're talking about these competencies in the companies, you understand what's going on, and the companies. So I think if I recall correctly, you shared good numbers, 25 or such, stocks within the portfolio, something like this.
Perhaps, I don't think that's a bad number. I currently have 22 in my main taxable brokerage account. And then my Roth IRA, I just have a couple of ETFs. So overall, I feel pretty well diversified. But if someone's just buying individual stocks, I haven't made up my mind completely on this, because part of me says just thinking about how much you can possibly manage as a human being with limited time, limited brain power. How many stocks realistically can you keep track of? That's going to be different for every individual for sure. But I would imagine that it's, once you start getting up there in number of holdings, it becomes increasingly more difficult. Right. And so I think you reach a point where it's just, you can't really stay on top of things anymore, which I think you should try and stay in the loop on your holdings to, how deep exactly. I don't really know. But I think it's important to listen to quarterly earnings calls at least, and just stay in tune in that way. And come earnings season, man, it can get pretty hectic pretty quick. And
Sure.
So, at least for me with 22 holdings right now, I'd feel good. I talked about 4 stocks that I've been wanting to sell. I think it'll feel good being able to get rid of all those eventually and bring that number of holdings under 20. Just that would probably feel a lot more manageable. Especially knowing that the ones that are left over, in theory are higher conviction holdings and ones that I ultimately feel better about. But at the same time, on the other hand, I also think it's natural as your portfolio grows in size and as you're working with a larger pool of money, I think it's natural to have the number of holdings expand over time. And I think rightfully so, actually. I think if you're working with a large sum of money, there's more to lose. There's more at stake. And so I think it makes sense to be a bit more protective of that by expanding your number of holdings and kind of being a bit more defensive in that way. And ultimately too, you know, if you're bringing, and some people might disagree with this, but just anyway, if you're bringing in $100, let's just use $100. Okay. If you're bringing in $100 of dividend income, it doesn't really matter if it's coming from 2 holdings or 3 holdings, or if it's coming from 50 different holdings. It's all the same amount of money at the end of the day. So I guess you could look at it from that perspective as well. But it also begs the question. It's like, well, you know, if you've got 100 holdings, are those all really good ideas? I don't really know. That's a tough question to answer. You could say with a high degree of confidence, I would imagine, if you have 100 holdings, you could probably get by with less. I'm sure everyone would, you know, agree with that. But like I said, if you have a large portfolio, like I think back to what's the gentleman's name from the Dividends and Income channel? You had him on here.
Dividends.
You always talk about him. He's got a lot of holdings in his portfolio. Jason Fieber. You know, he's working with he's worth
100 plus.
He's working with a hefty portfolio, both in terms of the dollar amount that his portfolio is valued at, but also just the number of holdings. And so if you're someone like him who's living off his dividends and is at that stage in the game, dude, I do think it makes sense to protect your wealth and protect that income stream as much as you can. And by being more spread out, that's one way to do so. I don't know. There's obviously different schools of thought on this, and you know, there's so much gray area, and I don't know if there's a right or a wrong answer. I know at this stage in the game, for me, you know, $55,000 portfolio, I'll be fine if I have like 20 holdings or less. I'll be okay.
Sure. Have you seen your portfolio evolve over time? Like, you know, as you went, you know, you're at 22, you're looking to go below now 20 holdings. How has your portfolio evolved, and how did it, I want to say, like, what were some of the, you know, looking back, I feel like this is such a reflective Masters of the Market chat, right? But looking back,
this is fun.
Yeah.
You got me in the ring of fire over here, man. Really, really in the hot seat.
grilling you, man, on every decision you've made.
Yeah. No, I need it.
I hope you have a dividend happy hour after this one.
Well, you know, it's about 10:20 here over in Las Vegas.
5 o'clock
so, you know, I'd say it's about time to crack one open.
How has your portfolio evolved over time? And more so, I'm looking to understand, like, how did your portfolio get to where it was? Whereas like now you're okay, you know, take 2 or take 3, like I gotta, you know, remove some of these holdings. They're no longer suitable for my portfolio. I don't want them anymore. How did that happen? Or how does it happen to an investor where, you know, and I guess, again, there's no right or wrong answer here, but how do you think it happens to us where loading up and spreading ourselves too thin, you know, just becomes a part of the journey for most of us? Is that avoidable?
Yeah, it's avoidable. I think a lot. That's such a good question, dude. Like I said, I'm in the ring of fire over here.
Yeah, I don't think anybody else who's been on so far has been asked such like difficult questions.
I love it, man.
By the way,
this, you know, I've said it before, and I don't mean to get off track. You have such a knack for interviewing people. You were meant to do this, and I feel so fortunate to be able to do this with you, man. It truly is an honor, and it's watching you do your thing it's great. So keep it up. Is essentially.
I appreciate
you're doing
that.
Yeah,
don't politically try to get out of the question though. Eh?
No. So I think it's avoidable to spread yourself too thin at first, but at the same time, like I said, when you first get started, if you were like me and didn't really know what you were doing, it's so easy to hear someone talk about a stock and especially when they only present one side typically, or talk about it for 60 seconds or, you know, 2 minutes. It's easy to hear someone go through that and you start to think you need that stock as well. So yeah, I think it's really easy to get to spread yourself too thin at first. I think that was the case for me, but yeah, I just think as you learn more, as you start to learn more and start to come into your own as an investor and start to kind of be able to connect dots and put things together, I think it's from that point on, it's pretty easy to start like deploying some hindsight and start looking at your portfolio and see maybe where you don't think the same now as you did when you first started. I'm actually kind of going through that. I'm still going through that in my portfolio. There's been quite a handful of stocks that I've sold out of that I bought when I was first getting going, watching various channels, thinking, okay, I need that stock that guy's talking about. I need that one. I need that one. So, there's been some of those that have worked out for me. There's been some that have not. And I'm still trying to go through and trim out some of the ones that I'm now thinking differently about. One example of that, two examples of that are AT&T and Verizon. Those were two of the
You're
first
still
stocks.
holding AT&T?
Yeah, I'm still holding it. And I'm losing some money on both of those. Which is fine. This is like the price of tuition of just being in the market. You know what I mean? So those are two examples of stocks that or companies rather, that I'm thinking differently about now than I did when I first started. And I remember, like, when I first started with those two specifically, I looked at them thinking, okay, the dividend's pretty sweet. That's a huge plus. At the time, close to 4 years ago now, both of those had pretty respectable dividend growth histories.
Yep.
And when you first start out, that's a really easy metric to look at and allow you to, seeing an extensive dividend growth history. It can tell, I want to say, as a beginner, you think that it tells you a lot about what the future for that dividend might hold, but you never know. Like, even dividend kings can cut their dividend. Seeing an extensive dividend growth history is nice, but it's also just one piece of the puzzle. But when you first start out, that's a pretty easy thing to look for. And it's a pretty easy metric to wrap your head around and understand why it could be a good sign. So anyway, with AT&T and Verizon, they both had pretty extensive dividend growth histories. Verizon still does. I think they've been growing it for close to 20 years. AT&T, I think they were a dividend aristocrat before they cut their dividend and spun off Warner Brothers. And I also thought with both of those, we're at a point where your phone bill, people have said it like this before, but your phone bill is almost like paying it's almost like a utility. It's like there's so many other things we'd sooner give up besides like our access to texting and our access to the internet and all the other things we do on this. This is just like something that it's like a necessity. And so I figured that people paying their phone bill would be as likely as them paying their electricity bill at this point. So those were kind of like the two things I remember that first got me into these two positions. But as time goes on and you get more experience looking at different businesses and different industries, and you explore some other things in your portfolio, you learn more about the stocks that you currently have. And my thoughts on those two companies have kind of changed over time. I mean, the dividend for both of them, I think that'll still be intact. I don't see that going away because it's a really important thing for like, management knows how important that is for the shareholders. They would, I don't know. I just don't see those going away. Anything's possible, but I think they'll do their best to keep the dividends intact. But like looking at them now and understanding more about how to read financial statements and understanding more about debt, and just understanding more so the nature of certain industries, I just look around and I think there's so many other things I would rather be interested in or invested in from a long-term perspective. As most people watching probably know, like AT&T and Verizon and a lot of the telecommunications companies are very highly leveraged, very capital intensive businesses. And that's just the nature of the beast. Like, they're constantly having to maintain their infrastructure and evolve their infrastructure from 4G to 5G to whatever comes after that. And that's just, as the demand for data increases, that takes a toll on them. And furthermore, so does our want for greater speed. So not only do you want more, but you want more faster. And so they're just constantly having to spend money to keep up with that. And that I just don't see why that will ever stop. And as I study more of this stuff, and especially as I read more from some of the greats out there, like the Warrens and Charlies, and even Morgan Housel talks about this a lot. I'm starting to come around more to the idea that, it may be better to look for businesses that are a bit more resilient to change and don't have to constantly reinvent themselves to keep up with things. And that's why Warren Buffett loves Coca-Cola so much. Like, you don't have to change the formula for Coca-Cola for the business to still be a good business. It's pretty much been the same throughout history. But I look at another example of that. Like, one stock that I'm looking at right now is a company called Rollins, ticker symbol ROL. and I'd love to add this company at some point. But this is one of the world's largest pest control companies. And there's a lot more to say about it than what I'm about to say here, obviously. But one thing that I think about is that's going to be a business that doesn't change too much. Like the method to killing cockroaches, in the same way that the Coca-Cola formula is not really going to change. You don't have to change too much about certain beverages. The method to killing cockroaches is not going to change much either. And, unless there's something crazy that happens in the world, there's going to be cockroaches to kill. So I look at something like that and think, number one, like I can wrap my head around a business like that. But number two, I can see how that might be more, they're not going to have to completely reinvent themselves or change things in a drastic way, or it's not as capital intensive in that respect as something like an AT&T and Verizon. And also doesn't require as much leverage to operate and maintain. So I can start to look at other things and other industries and other sectors and start to, I guess, compare and contrast. And yeah, I just think that's the natural evolution for an investor. You know, sometimes to find the businesses that are worth holding, or to find the ones that you actually want to be in, you have to first own the ones that ultimately don't end up working out. And that's just how it goes. Like I said earlier, you're going to make mistakes, and it's not necessarily so much that it's a mistake, because there's a really important lesson to be learned from that. And everything the crazy thing about investing is what I just said now, man, we might be having this conversation 10 years from now, and I could think in a way that's even different than today. And I wish I knew if that was going to be the case, but you don't. Like, that's just the journey.
Sure. No, that's great, man.
Does that all make sense?
100%. First of all, I held AT&T too. So I laughed because I said, when you're still holding it, I sold it at a loss. But what was interesting as you were sharing, I was reflecting, on what you were sharing, and then in my own, dividend investment journey. I too bought into the Verizon and AT&Ts because safety and reliability for that dividend. And over time, I have changed, my investment strategy, certainly in terms of the dividend stocks that I'm going to look into. And it's gone from more of needing that safety, comfort, and reliability to growth, seeking the dividend growth. And I'm curious to know, on your end, has there been a shift there?
That's a really good question, man. You are knocking it out of the park. In my portfolio, I like to keep a balance. I've got some high yielders, but I also have some more dividend growth stocks. I don't really discriminate between the two. I think ideally for me, I'd like to maintain that balance. Like my yield in my portfolio is very respectable. I've got a near 4.5% yield, or about a 4.5% yield. And my dividend growth rate, with that said, is overall is not bad either. It's getting close to about 7%. For my weighted average 5-year dividend growth CAGR, when you take into account all my holdings and the weighting of them. So I like that. I like having that well-balanced approach, versus being someone who's just all in on dividend growth, or being all in on something that's high yield. I like having some variance in that regard. And I always talk about this too. We both do. The importance of having dividend growth. Like, I don't think you should shy away from that at all. But I also don't think one needs to necessarily avoid high yield stocks altogether. Like, I think AT&T and Verizon have a place in some investors' portfolios. I think I just think it depends. You know what I mean? And I look at my portfolio and I just kind of looking at where everything is just in terms of dividend stats. And I'm looking at some of the high yielders that I have, like the AT&Ts and Verizons, and even JEPI, which is another one that I'll probably sell out of here soon. And I look at those and I think I've got room to consolidate here, because I've got, if I don't want to lose my yield or take steps backwards in the income by making these moves in the portfolio, I've got some other like high conviction, higher yielding picks that I can turn to kind of make up for selling out of AT&T and Verizon and what have you. And I look at some other positions in my portfolio, like EPD or like Realty Income, another good example. And I look at those and I think those are pretty solid high yielders, and I'm happy to own those and have a bigger stake in those. And so I don't know that, like I said, I don't know that I necessarily the moves that I'm kind of talking about, I don't think that it necessarily reflects a change in leaning more towards high dividend growth. Although, if you look at my watch list right now, it's pretty much all dividend growth stocks, lowish yield, higher dividend growth. So I guess that is kind of what I'm looking for. But if I find a high yielding company that I think is going to be a good investment, then I wouldn't shy away from it. So, but yeah, I certainly have room to have some more dividend growth right now because I do have quite a few high yielders. Does that all make sense?
Yeah, 100%. No, it's just fascinating to over time, you're looking at what you were initially investing in and the why and the rationale. And, fast forward again, I had Matt Darren, as on here, was another one who was totally focused on dividend growth. I had the dividend guy on here, also totally
Yeah.
focused on dividend growth. And it was just fascinating to learn, and that's prompted more of my attention personally into dividend growth because I'm like, I did have dividend growth, stocks within my portfolio, but I shifted more recently towards more dividend growth stocks. I've been piling up on McDonald's and Visa, to be honest with you, because I want more dividend growth in my portfolio, but also just they're also reliable companies that are going to be, I feel like agile no matter what comes down the pipe, but and I think you're right. There is a place definitely for Verizon and AT&T in someone's portfolio. What place would you say, that is to have more of the high yielding dividend stocks versus the dividend growth stocks? What
I think
place would you give them?
I think the obvious answer would be like if you're in retirement and you need more current income, then something like that could make sense. And I totally think that's true. But now that I'm thinking about it, just kind of thinking out loud, outside of that, I'm not sure because I don't see either of those businesses delivering much in terms of any meaningful return, just both in terms of a share price,
Sure.
but also dividend growth. I don't see you getting a lot of growth or share price gains from those. So with that said, all they really have to offer is the yield. And so if you're someone who's buying it today, I can't picture much of a circumstance that it would make sense to chase that income if you still unless you just actually need it today and want to live off it today. But having said that, it makes me think about some of the other holdings in my portfolio that one might say something similar about, like Realty Income, or maybe like Main Street Capital Corporation or Blue Owl Capital Corporation, which are all high yielders as well, or even WP Carey. And kind of distinguishing between those two sort of things, I think with the ones I just listed, I think you'd still, on a total return basis, see much greater returns from all those than you would with something like AT&T and Verizon.
Sure.
And I'm just thinking out loud here. But yeah,
I
I
don't,
think
I don't, I never
if you're
saw,
going
for
for,
example, with Verizon and AT&T, they to me, even when I held them, they traded sideways primarily, versus Realty Income. It's going to fluctuate depending on the macro environment, which is what we've seen more recently. And, this begs the question, speaking of the macros, right? I'm always about the macros matter. And we did just get the latest CPI, 3.2%, which prompted a nice little rally run up there in the market on Tuesday and Wednesday. What do you
yeah,
think, closing out here the year of 2023, which is crazy how fast time flew. How do you think this year is going to end? How do you think, you're going to head into the new year? You're on your walk to 100 right now as we speak. And, the consistent walk to 100. Do you think you're going to make any adjustments, heading into the new year? Is there anything on the horizon here? Are you tax loss harvesting anything?
I think by the end of the year, I'll have sold out of JEPI.
What's the reason for that?
It's a good question. When I first bought the fund, I bought it maybe a year after it came onto the market. It came onto the market, I think, in October 2020. And I bought JEPI like November 2021. And at the time when I bought it, like covered call ETFs were all the rage. Everyone was talking about covered call ETFs, JEPI, QYLD, XYLD, RYLD. Those were the hot new thing. And I was intriguing, excuse me, I don't trade options personally, but I liked the idea of owning a fund that generated really nice monthly dividend income from trading options, getting some of that exposure, I suppose, without having to do it myself. And I think it's not a huge position of mine at all. I maybe put like $1,000 into JEPI. And I didn't really, truth be told, I didn't really have a super strong thesis for investing in something like that. It's not one of those things that you look at and think, I think this is going to deliver market beating returns. I think over a long period of time, I'll probably have some crazy returns from JEPI. This is going to be a killer position. And, it's going to be a game changer in my portfolio. You're buying it for the income. That's all covered calls and puts are, though. Cash secured puts. You're just doing it. You're doing it because you want the income. And so that was it for me. It was just, yeah, why not? Let's try it out. This is kind of the hot new thing. Let's just try it out and see how it performs. I won't put a huge amount of money into it, but let's just see how it goes. So I didn't really have like a strong, any super strong conviction in it. But with that said, when I bought into it, I'd always known that it wasn't going to be something I was going to hold on to forever. It was just kind of like, yeah, let's put a little bit into it and see where it goes.
Sure.
And I think that's the first. I don't know if it was the first, but I think that's the last time I will ever do anything like that. I just, in hindsight, once again, you realize that doesn't really align with your overall objective. And like, for me, I kind of look at my portfolio as and I'm starting to more so as just kind of as like a collector. I want to collect good businesses that I think are going to be good ones to hold for a long period of time. And in a way, your portfolio, if you approach it like that, it's kind of like an extension of the way that you think about the world and how things are going to go, which I think is, people ask, why not just invest in ETFs? That's why, because I think it's fun to do this and fun to try and to custom pick the ones that you think are going to be good. But with that said, JEPI, it's not really that. It's not a business. It's not something that I can look at and think, I think this is going to be great 10 years from now. It's like, you're just buying it for the income, which is fine. But I just don't know that's in alignment with what I'm really trying to do. And it's not something that really excites me. And so therefore JEPI is really not going to be, and I'm not saying this like I'm attached to my holdings. I think you kind of do, and that's a hard thing to avoid. But like, I just don't care about JEPI. It was just kind of like, yeah, let's see what happens. And I don't think these days, I don't think that's good of enough reason to hold on to something. And so I look at that and think about that and realize there's a better use for this. I can put this into so many other things that I own and have, feel more confident about. And also things that do not pay a variable dividend that goes up and down and up and down. And in JEPI's defense, like JEPI's done, I don't have any serious qualms about the fund. I think it's done exactly what its objective is, which is to deliver monthly income with less volatility. And it's done that, so I'm happy with my experience owning it so far. I think it's been fine. But like I said, I just think there's better things to do with that money. And so I'm kind of ready to move on from it. You know what I mean?
Sure. And now heading into the new year, what are some of the stocks that you're looking at or tax loss harvesting?
Yeah. So that's the other question mark, is like, do I sell out of AT&T and Verizon now? Or, things have been really good on the market. So do I hold on and see if I can maybe recoup some of the current losses that I have? I don't know. That's something I'm still thinking through, but I'd like to make a decision by the end of the year, because it'd be nice if I am going to sell to tax loss harvest for this current year. So we'll see what happens there. And as far as, adding stocks to the portfolio, I might. I've got, a few different stocks on my watch list right now that I'm looking at. The only one that I'm really seriously want to add is Rollins. And I just don't know if it's at the valuation that I want it right now. So I'm just I'm really trying to be patient. And that's also a lesson that I've really had to learn the hard way, is not to rush into positions, because I think I've made some good choices, but at the wrong time. Like KRC is a stock that I talk about quite a bit, and people have heard me like talk about it till I'm blue in the face. I feel really good about that stock, and I feel really good about that company. And I think 5 or 10 years down the road, I'll be happy that I have it. But I was a little bit early in my entry. I was not patient with it, and I didn't think about that entry well enough. And so, it's been one of those falling knives for me, which has been fine. I've really done an okay job of lowering my cost basis, but I think I rushed into starting that position and should have been more patient. I think I did the same exact thing with Intel, which I also think that ultimately that's another one that I want to sell out of, but I think I will be able to sell that one for a profit. But man, if I would have waited a little bit longer, Intel got down to less than $30 a share. Could you imagine? Like, he'd be in a much better situation right now or I would be in a much better situation if I just was more patient with it and just waited for, waited for certain things to play out.
Sure.
So that's been another big lesson for me. And so with Rollins, I'm trying to carry it into starting that position, just really kind of pumping the brakes.
Do you have any suggestions on how someone can gain that patience? Like, I'm here every time I listen to you, speak, whether it's on your own channel, whether you're on Masters with me, whether we're, going back and forth in the voice notes, what I hear is this cool, calm, and collected Ryne. So it's interesting, to kind of get this inside scoop from you that, you need to be more patient. How would you go about, practicing more patience? How do we do it?
Dude, I honestly don't know, because that's the hardest part. The hardest part about being an investor is being patient. And I may be wrong with Rollins. Like I'm saying, I want to be patient and wait for it to get to a lower share price. But what if that never comes? What if it just keeps going up? And things sometimes, like what goes up must come down, at least in the short term. But man, what if it doesn't come down to where I want it? What if in trying to be patient, I've missed an opportunity? That's such a tough thing to reconcile. That's such a tough thing to gauge as an investor. And you never know, like you never know what's going to happen. So you can't predict that. But as far as being patient and learning how to do it, I don't know if you can. I just think, well, you can, but I just don't know if it's something that's ever easy. It's not. We all want instant gratification. We all want things to happen now. But I think by not pulling the trigger immediately, I think it does force you to sit and think, what do I think is going to happen next? And I know you do this on a macro level a lot. What do I think is going to happen next in the market? Do I think they're going to raise interest rates again for whatever reason? So, the gain that the recent boom that we just had this week might not last, or is it done? And they're going to cut rates, and then, there goes the opportunity for those discounts. I have no idea. I'd love to see cheaper prices, though. I do.
Likewise, man. I have a smile on my face. I was texting yesterday, or 2 days ago, Kevin Burgess, and
Kevin,
APD,
the king of cash flow.
Yeah,
he's
an undercover, really, like dividend king, Kevin. And if anybody out there hasn't checked out his channel, go there immediately after Ryne's walk to 100, and after this, right? Go to Kevin's
one of
those
channel. Kevin's one of those guys who every time you listen to, you learn something new. And
I had him on 4 times.
Yeah, I know. And I watched every single one. It was great. And he's just such an asset to this community, man. He's one of a kind and a really nice man. So we're fortunate to have him. Everyone should be watching him.
I want to say a natural born teacher. Gifted, very gifted, dude. Natural born teacher, like passionate guy. I was texting him the other day though, because I said, hey, APD, air products and chemicals is looking really sweet right now. What do you
Yeah.
think? And Kevin goes, I put 10 grand in, and immediately I got excited, right? Because I'm like, and I'm bringing this up because we're talking about patience, and I got really excited. And on the day, it was I think 2 days ago, I
Dropped
was like, man, do I
11%.
throw money in now? Like I should. Kevin already did it, right? And so I threw money in, and then what happened a couple hours later? Not the biggest difference. It was like nominal, $2-3. But over the span of time, when you're not investing $1 million, you know, $2-3 is kind of a little sum for me that I'm like, I would have liked to have had, that $2 to $3 difference. But
Yeah.
even then, I caught myself, man, in this game of practicing patience. The whole day I was staring at my phone, just saying, is APD going to come back down by the end of the day for me to go ahead and get invested? So I guess the real question I have for you is like, does it matter, right? Even on this position you're talking about that you feel great about, but over the course of 10 years, does it matter?
No, not really. But at the same time, you want to do the best that you can.
Yeah.
You want to be the best investor that you can. And so if by deploying more patience today and ultimately having it turn out the way you want to, that's just going to that's going to be a better move. As an investor, you'll be able to establish a better position than if you didn't wait and if you weren't patient. But no, like hypothetically, if I was to buy Rollins today, I think I'd still probably have a nice return down the road. And that's something that I really think about. Like, having said that, Ari, I'm glad that you said that, because it makes you think, well, if that's true, Ryan, if that's really how you think, why not just, well, then
Pull
what's
the
the point
trigger.
of waiting? What's the
Yeah.
point? I don't know if there is one.
It's
It's kind
just
of the
Ryan's
mind
next
trip about
video,
investing.
dividend stock to buy immediately.
Dude,
Rollins.
basically the title of all my videos in the general theme for the channel is just, I have no idea. I'm just
Yeah.
trying to figure it out. I'm just trying, man.
But you're on this walk to 100. And look, whatever you're doing over there is working, because guy said 3 months ago you were on here, you just popped above 50, and now you're back on here only 3 months later. That's really not that much time, blink of an eye, and you're above
Yeah.
55. By the way, the market, as we all know, has been stir crazy. So kudos to you, right? That's a 5 grand on top of just popping above the 50 3 months ago. I want to wrap up with a very interesting question that I've now had in mind for you, just about the whole hour here, which is,
Has it only been an hour?
so I think maybe even longer. It's always a good conversation with you. I even
Yeah.
our chats on voice notes, right? It's just like, it always gets me thinking. But I
Hmm.
feel like I got to toss this question out to you, especially as you're midway through your walk to 100 to $100,000, which I have no doubt soon you're going to be there. Ryan, man, if you were to be remembered as a dividend investor for like one thing, you complete your walk to 100, and let's just say, I don't know, your YouTube channel vanishes, or you just decide that you no longer want to be a YouTuber, whatever it is. You did your walk to 100,000 now in your portfolio. What's the one thing that you'd want to be remembered for as a dividend investor?
Really good question. I think about this a lot. What's the legacy you want to leave behind? If how do I say this? If I can get people excited about investing, if I can get people to start, just to start, that's a huge win for me. That's all I want. I'm not the most knowledgeable investor. Obviously, I'm still, like I said, I'm trying to figure it out as I go. I'm learning from scratch. It's been quite the journey, but if I could be someone who showed people that that's okay, that you don't have to have a PhD in finance to be an investor, or to enjoy investing as well. If I can just be someone that rallies the troops and gets people psyched about this, and can get people to make the decision just to start and never give up and never stop, and that's that's a huge win for me. That's really all I want out of all this.
An
So
incredible answer. Wouldn't expect anything
thanks,
less.
man.
Investors, got to go check out Ryne's Walk to 100. Definitely, it has been a series that has captivated my attention over the past week now, watching Ryne day in and day out on his walk. Ryne, I want to say thank you, man, again for joining me on Masters of the Market. I hope the next time you're on here, man, you're actually at the $100,000 mark and you've burned a few dozen 100 calories while you're at it.
Well, thank you, man, dude. Thank you so much once again for having this conversation with me. I think this has been one of our better conversations. You're just so good at this, man. You've got the best questions. Really put me in the ring of fire. So thank you. I hope we chat sometime before I hit 100K because it's going to be a while before I get there. Like I said,
Give it another 3 months. We'll figure out where you're at in the walk. The
dude,
lessons learned, the harder
yeah,
questions.
right. It might take me another 2 or 3 years I bet it takes me another 2 years to get there, maybe 3 years. But yeah, we'll definitely talk before then. But thank you, man. This is awesome.
Of course, man. And investors, I want to say thank you to each and every one of you for joining us. Until next time, we will see you all in the next one.